Hi there, welcome to my channel where I dive into fascinating economic trends and analyze their impact on society. This video is sponsored by Momoreitzoch Tech and Tools. The collapse of Silicon Valley Bank (SVB) in March 2023 was a major shock to the financial world. The collapse of SVB was a significant event in the global financial system, as it was the first major US bank failure since the 2008 Great Financial Crisis. The failure was caused by a number of factors, including the bank's exposure to risky technology companies, its high concentration of deposits in a small number of large customers, and its reliance on short-term funding. The bank, which had been founded in 1983 and had become a major player in the tech industry, was forced to close its doors after a run on deposits. As I discussed in a previous episode in this series, a bank run represents a crisis of confidence that can have severe consequences for financial institutions and economies. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Topics cover a wide range of financial and economic issues that affect individual countries or the world economy. For instance, COVID-19, inflation, or the war in Ukraine. Please also subscribe to this channel and be informed whenever we publish a new video. A bank run occurs when many depositors simultaneously withdraw their funds from a bank due to concerns about its solvency, triggering a chain reaction of panic among other depositors. Interconnectedness within the banking system can amplify the effects of a bank run. If one bank faces a crisis, depositors may withdraw funds from other banks due to concerns about their stability, even if those banks are fundamentally sound. This contagion effect can escalate the scale and severity of a bank run. There were a number of factors that contributed to SVB's collapse. One was the bank's heavy exposure to the tech industry. As the tech bubble began to deflate in 2022, SVB's corporate clients started to withdraw their deposits. This put a strain on the bank's liquidity, and it was unable to raise enough capital to meet its short-term obligations. Another factor that contributed to SVB's collapse was its investment strategy. The bank had invested heavily in long-term securities, such as treasuries. When interest rates started to rise in 2022, the value of these securities fell. This further eroded SVB's capital base and made it even more difficult for the bank to raise capital. Finally, SVB's management also played a role in the bank's collapse. The bank's executives were slow to react to the changing financial environment, and they made a number of decisions that ultimately led to the bank's demise. For example, the bank's executives refused to sell some of its long-term securities, even when it became clear that these securities were losing value. This decision further exacerbated SVB's liquidity problems. The collapse of Silicon Valley Bank was a major setback for the tech industry. The bank had been a major source of funding for tech startups, and its closure made it more difficult for these startups to raise capital. The collapse also shook investor confidence in the tech industry, and it led to a decline in the value of tech stocks. The failure of the bank also raised questions about regulatory oversight. The bank had been subject to the same regulations as other banks, but it was able to evade these regulations by structuring its investments in a certain way, This suggests that the regulatory system may not be as effective as it should be in protecting investors from bank failures. This bank's failure is a reminder that even the most well-respected banks are not immune to failure. The bank's collapse also highlights the importance of diversification and prudent investment management. Banks that are too heavily exposed to a single industry or asset class are more likely to fail when the environment changes. The September 2023 Bank for International Settlements Quarterly Review highlights the following lessons from the collapse of SVB. Banks should be careful about their exposure to risky assets. SVB had a large exposure to technology companies, which are often more volatile than other industries. This exposure made the bank more vulnerable to losses during a downturn in the technology sector. Banks should diversify their depositor base. SVB had a high concentration of deposits in a small number of large customers. This made the bank more vulnerable to a sudden withdrawal of deposits by one or more of its large customers. Banks should maintain a healthy mix of funding sources. SVB relied heavily on short-term funding, such as repurchase agreements. This made the bank more vulnerable to a liquidity crisis if market conditions worsened. The BIS Quarterly Review also discusses the policy implications of the collapse of SVB. The review argues that regulators should carefully consider the risks associated with banks' exposure to risky assets, their concentration of deposits, and their reliance on short-term funding. Regulators should also consider whether additional measures are needed to protect depositors in the event of a bank failure. In addition to the lessons learned from the collapse of SVB, the BIS Quarterly Review also discusses the broader implications of the bank's failure for the global financial system. The review argues that the failure of SVB highlights the importance of financial stability and the need for regulators to be vigilant in monitoring the risks to the financial system. By combining prudent regulation, deposit insurance, crisis management mechanisms, and transparent communication, policymakers can strive to minimize the occurrence and impact of bank runs, thus fostering a more resilient financial ecosystem. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support. Thank you for watching, and until next time, stay curious and keep exploring the world of economics.